What does Warren Buffett really think about tariffs, Doge, and President Trump? The answers may surprise you. Hello, members, super savers, and Bond Course fans. I hope you're healthy and well. So this past weekend was the annual general meeting, or AGM for short, of Berkshire Hathaway in Omaha, Nebraska. And it was also Warren Buffett's 60th AGM for Berkshire, a bit like a farewell meeting, or dare we say it, a last hurrah. Even Tim Cook, the CEO of Apple, attended in person this time. Berkshire Hathaway, as many of our Diamond Nest Egg regulars know, is part holding company and part investment fund, so to speak. And they've been extremely successful over the past few decades with Buffett as chairman and CEO. And even at 94 years old, Buffett was as lively and in control as ever as he chaired this year's AGM before a record audience of around 40,000 shareholders in the Omaha Stadium where it took place. Like every year, the highlight of this AGM was Buffett's 4.5-hour Q&A session with shareholders, which was broadcast and live streamed all over the world. There's a reason Berkshire's AGM is so often referred to as the Woodstock for capitalists, after all. For those of you who attended the AGM again in person this year, or who watched the live stream, drop a comment below and let me and the community know what your favorite moments and or insights were. Because in today's video, we'll be sharing with you the 5 key takeaways that we gleaned from Buffett's Berkshire farewell. These 5 key takeaways cover tariffs and trade, Doge and the Trump administration, Berkshire's ever-growing cash position, the market outlook and investment opportunities, as well as what's next, and some of what we found may surprise some of you. As usual, here's our front video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Takeaway number 1, tariffs and trade. Here are the top headlines that we got over the weekend when we did a quick internet search of Buffett, tariffs, and the Trump administration. From CNBC, Warren Buffett knocks tariffs and protectionism. From Newsweek, Warren Buffett issues warning on Donald Trump tariffs, act of war. And from CNN, supply chain expert reacts to Warren Buffett's criticism of Trump's tariffs. I think you get the picture from some of these legacy media headlines. Warren Buffett thinks tariffs are bad. The thing is, that's not really the full story. So, let's talk about what is the full story. Buffett is a huge fan of international trade, and equally important, a strong proponent of balanced trade, with the key word here being balanced. In fact, Buffett showed in his own analysis from over 2 decades ago that the U.S. trade deficit is not sustainable in the long run, and that we may require some kind of tariff to achieve balanced trade. That said, he seems to think that Trump's way of addressing tariffs may be too brash and aggressive. In other words, in our mind, it's not necessarily tariffs in general that Buffett is against, but rather President Trump's approach to tariffs specifically. And to understand what I mean by this, let me first give you a bit of background on Buffett's original analysis on balanced trade and tariffs. Back in 2003, Buffett published this article in Fortune magazine that has been making the rounds recently. You can already see where this is going from the title. America's growing trade deficit is selling the nation out from under us. Here's a way to fix the problem, and we need to do it now. Buffett then explained that by permanently importing more than we export as a nation, we are putting our country in danger. In effect, our country has been behaving like an extraordinarily rich family that possesses an immense farm. In order to consume 4% more than what we produce, that's the trade deficit, we have day by day been both selling pieces of the farm and increasing the mortgage on what we still own. And for those of you who may be wondering, yes, the trade deficit is still around more than 20 years later. And no, it hasn't really gotten much better. In 2024, the U.S. still showed a deficit of around 4% of GDP from trade in goods. Or, if you include our smaller surplus from the export of services, we had an overall deficit of around 3% of GDP from trade in both goods and services. But back to the article. Buffett then goes on to propose a remedy for fixing the deficit. He calls it import certificates, or ICs. And we won't go into detail here as it's a bit complex and can get very technical very fast. For those of you who want to read up on Buffett's proposed import certificates, I've linked this article below in the first pinned comment for you. In typical Buffett style, the article is very well written and explains his import certificate or IC solution for fixing the deficit and balancing trade very clearly and in an easy to understand manner. For the purposes of today's video, I think Buffett described his import certificate or IC idea best when he says, "My remedy sounds gimmicky, and in truth, it is a tariff called by another name." Now, if that sounds like an endorsement of higher tariffs on imports into the US to you, you're not alone. And indeed, this was the very first question that Warren Buffett got at the AGM. As the moderator said, they received more questions about tariffs in advance of the meeting than on any other topic. In his answer, Buffett confirmed that he still thinks that we need to do something about our persistent trade deficit. Trade is good, but it still needs to be balanced, so to speak. In his own words,
I think you can make some very good arguments for the fact that balanced trade is good for the world, and the more balanced trade there is, the better.
Now, by arguing for as much balanced trade as possible, he was not contradicting or disowning his 2003 article that higher tariffs on imports may be needed to balance trade out and make it sustainable. That said, Buffett seems to think that the way Trump went about his tariffs may have been too aggressive. And the main risk he sees seems to be less the impact that the tariffs might have on our economy, but the fact that we may risk losing our friends, as we've talked about often on this channel.
And it's a big mistake, in my view, when you have 7.5 billion people that don't like you very well, and you got 300 million that are crowing in some way about how well they've done. And I don't think it's right, and I don't think it's wise.
Meaning that even if new tariffs made the 300 million people in the US very happy, this might not last if we turn all the remaining 7.5 billion people in the rest of the world against us, even our current friends. So, as we interpret it, his message this past Saturday on tariffs could be summarized as follows. You may have to do it to balance out trade, but do it smartly and without losing our friends and allies. That said, even back in 2003, Buffett was pretty clear-eyed about the fact that exporting nations might, quite naturally, not be happy if the U.S. looked after its own interests and started balancing trade and fixing its deficit. Foreigners selling to us, of course, would face tougher economics. But that's a problem they're up against no matter what trade solution is adopted. And make no mistake, a solution must come. As Herb Stein said, if something cannot go on forever, it will stop. And he meant our trade deficit by that. And one final thought from the 2003 article. Buffett also openly acknowledged the likely negative impact that tariffs may have on U.S. consumers. There is no free lunch in the IC plan, his more sophisticated mechanism for imposing tariffs. Prices of most imported products would increase, and so would the prices of certain competitive products manufactured domestically. The tariffs, even with his mechanism, would therefore typically act as a tax on consumers. That said, Buffett repeated that he sees no credible alternative to his ICs or tariffs. The pain of higher prices of goods imported today dims beside the pain we will eventually suffer if we drift along and trade away ever larger portions of our country's net worth. So, plenty of food for thought already from the very first question of the AGM. And we can only assume and hope that President Trump may have taken a page from Warren Buffett's playbook when he recently seemed to soften his approach and tone on tariffs with our key trading partners and allies. Perhaps we may even see a version of Buffett's import certificate solution as part of the administration's overall long-term strategy to a more balanced trading world. Who knows? Moving on now to takeaway 2, Doge and the Trump administration. Apart from tariffs and trade, there were many questions from the audience trying to tease out some comments from Buffett on the Trump administration. Well, we felt that he politely but consistently avoided doing so, and that was the Wall Street Journal's impression as well. Investors at times sought Buffett's thoughts on the Trump administration and its policies, and each time he sidestepped making any direct critiques or compliments. That said, Buffett did make a few comments that gave us the impression that his thoughts about the Trump administration overall might be quite similar to how he framed his comments about trade and tariffs. The how, the style of what the administration is up to, might not always be what he would have wished for, but still, Buffett seemed to acknowledge that the what may be valid in many cases, that the administration is finally trying to address some problems that had been allowed to fester for way too long. One telling example was about DOGE and the federal deficit. After making a joke about DOGE, the Department of Government Efficiency, that elicited much laughter in the audience, Buffett got serious again and confirmed that he sees our federal deficit as a serious issue and that balancing revenue and expenses is something that needs to be done, even if he didn't want the job himself.
I wouldn't want the job of trying to correct what's going on in revenue and the expenditures of the United States with roughly a 7% gap, when probably a 3% gap is sustainable. And then the further away you get from that, the more you get to where the uncontrollable begins. And I think that it's a job I don't want, but it's a job I think should be done.
So these days, it seems that it's tough not to mix business and politics, even at Berkshire's AGM. But as usual, Buffett did this masterfully before he moved on to the less politically driven questions, which brings us nicely to takeaway number 3, Berkshire's ever-growing cash position. Berkshire Hathaway's already impressive cash pile grew by another 4% over the last 3 months, to a total of $348 billion, from an already impressive $334 billion previously. Cash, including short-term investments in U.S. Treasury bills, now makes up 30% of Berkshire Hathaway's balance sheet. In case you're looking for this information in the financial report for the first quarter of 2025 that was released right before the AGM, do note that to get to the full $348 billion in cash and short-term investments, you need to add up from the insurance and other section cash and cash equivalents of $36.892 billion and short-term investments in U.S. Treasury bills of $305.501 billion, as well as from the section railroads, utilities, and energy, cash and cash equivalents of $5.288 billion. As in the last meeting, Buffett defended holding so much cash and repeated that by not being fully invested at times, Berkshire would be ready for opportunities when they came along. That said, he also cautioned that the right opportunity was very, very unlikely to present itself tomorrow. Now, despite Buffett's protestations to the contrary, many market observers saw both the large cash holdings as well as these comments as a very defensive positioning and not exactly as a strong signal to jump into the market right now. And even more so because Berkshire Hathaway themselves were also a net seller of shares during the quarter, and investments in equity securities went down a bit, from $272 billion to $264 billion per the end of the first quarter, bringing us to takeaway number 4, market outlook and investment opportunities. Buffett didn't seem to give away too much in terms of market outlook or investment opportunities at the AGM, beyond some general reaffirmation of his preference for equities over real estate for reasons of cost and ease of investment. But there was one particular question he answered that did stand out to us and that we thought our Diamond Nest Egg regulars would appreciate hearing. When Buffett was asked about the recent market volatility in April, he reminded everyone that a 15% swing in equity markets isn't really something out of the ordinary. He had seen much worse himself repeatedly, and you may have seen some headlines from this exchange about "this is really nothing."
What has happened in the last 30, 45 days, 100 days, whatever whatever you want to pick up, whatever this period has been, is really nothing. There's been 3 times since we acquired Berkshire that Berkshire has gone down 50% in a fairly short period of time. 3 different times. Nothing was fundamentally wrong with the company at any time, but this is not a huge move.
Buffett then went on to remind the audience that equity markets have always been volatile and will remain so, and you'll need to accept that as a long-term investor. Don't panic, as we always say here at Diamond Nest Egg. Or, in Buffett's words, if a 15% stock market swing scares you, you may need a different investment philosophy.
But if it makes a difference to you whether your stocks are down 15% or not, you need to get a somewhat different investment philosophy, because the world is not going to adapt to you. You're going to have to adapt to the world.
So, with that gentle reminder about always keeping a long-term perspective as an investor, let's move on to takeaway number 5. What's next? Greg Abel is who's next. Now, it had been clear that Greg Abel would be Buffett's chosen successor for the job of CEO at Berkshire Hathaway. This was already announced in 2021, but no definitive timeline had been given. Some folks were even beginning to wonder whether the succession would happen at all. It was only at the very end of this AGM that Buffett announced that he would actually be stepping down.
And that would mean that at year end, Greg would be the chief executive or officer of Berkshire, and I would still hang around and could conceivably be useful in a few cases, but the final word would be what Greg said.
It appears that Buffett's son Howard Buffett and his daughter Susan Buffett were the only Berkshire directors whom he told about his plan beforehand. According to the Wall Street Journal, not even Abel, sitting nearby on the stage of Omaha's CHI Health Center, knew Buffett's thinking on the timing of his succession plan before he revealed it in the closing minutes of the annual meeting's question and answer session. For those of you who do not know Abel, he's the chairman and CEO of Berkshire Hathaway Energy and the vice chairman of non-insurance operations of Berkshire. Abel will have some big shoes to fill, but the good news is Buffett seems to have left him with a lot of cash to fill those shoes with. So what do you think? What was the most or least surprising of the 5 key takeaways that we shared with you today? And what do you think of Greg Abel and investing in Berkshire Hathaway now that Buffett is leaving the helm? Drop a comment below and let me and everyone else know. And for those of you who subscribe to Your Financial Journey, check out Ava's brand new video here for a deeper dive into how tariffs really work and who ultimately pays. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building a bond portfolio while rates are still at good levels, then check out this video here on our bond courses. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.